Welcome to Spidel's Federal Tax Minute. I'm your host, Catherine Sedan. This week we're covering what the phase-out of the penny means for sales and use tax purposes. Spidel's 2026-2027 Federal Tax Update webinar will cover Trump accounts, the tax impacts of tariff refunds, the new electronic payment mandate, and OBBBA changes going into effect in 2026, plus more. For details and to register, go to spidel.com and click Webinars. On November 12, 2025, the U.S. Mint struck the final penny after more than 2 centuries of circulation. According to a 2024 report by the U.S. Mint, producing and distributing a single penny costs 3.69 cents, and in 2024, the Treasury incurred a loss of $85.3 million on penny production. However, this change raises tax compliance questions that businesses and their tax professionals are still sorting through, such as should sales be rounded to the nearest nickel before or after tax, and should all sales, both cash and credit, be rounded, even though pennies can still be charged on credit sales. Unfortunately, there has been no federal legislation addressing these issues, which means that states are left to come up with their own policies, resulting in businesses facing a hodgepodge of policies and regulations depending on where the transaction occurs. Multi-state businesses will have to pay close attention to where sales occur and which rounding rules apply in those states. The question whether rounding occurs before or after tax has been clear and consistent across all guidance provided by the states that have addressed this issue. Rounding always occurs after sales tax is calculated and applied, never before. If it occurs before, the sales tax base will be the amount actually collected. The National Conference of State Legislatures recommends symmetrical rounding for cash transactions. Amounts ending in 1, 2, 6, or 7 cents round down to the nearest 5-cent multiple. Amounts ending in 3, 4, 8, or 9 cents round up. This is also known as the Swedish method. However, many states are taking different approaches, and some states are allowing businesses to decide which rounding method they want to apply. With the exception of Michigan and South Carolina, the states that have issued guidance have consistently stated that the rounding rules only apply to cash transactions, not credit card transactions. The guidance issued by Colorado does not specifically address this issue, so it remains an open question whether they'll end up in the same camp as Michigan and South Carolina. Although all the states that have issued guidance allow businesses to round up or down to the nearest nickel the transaction price charged to the customer, all of the states have stated that the amount of tax due to the state is based on the sales price of the good or service prior to rounding. The states that have specifically addressed the impact of rounding on income and franchise taxes have stated that the full amount charged after rounding is used in the tax base for those states. For example, if an item costs $3.62 and after sales tax the cost is $3.89, but the business charges the customer $3.90 after rounding, $3.90 will be used for the purposes of the business's gross income tax base. Spidel has numerous upcoming live webinars on a wide range of topics such as effective retirement planning, IRC Section 1031 exchanges, understanding the business interest limitation, tax planning for the end of 2026 and into 2027, and more. To see the full list of offerings, go to spidel.com and click Webinars. That's all for this week. Join us next time for another episode of Spidel's Federal Tax Minute.